Alright, today I'm going to be showing you what you should look for precisely before an earnings report so that you know which way is going to be the more likely way the stock moves on earnings. Now, I want to be very specific about what I'm talking about first so nobody's confused, and then I'm going to get into the actual indicators you should be looking at. So, just so everybody is on the same page, what I'm talking about is you buy the stock before an earnings report, and then you sell it after the earnings report and take the profit of the rally or sell-off that happened on earnings. Now, this is just an example. I'm not even sure if this company reported earnings in the past 30 days. I'm going to show you an example because you need to know what the chart looks like. Generally, what happens on an earnings report is if the stock reports good earnings, you'll see a gap. In many cases, you'll see a gap like this, where you have a space between the two candlesticks. So what happened was either on market, before the market opened on this day, or after the market closed on this day, this company reported earnings, and it was a set of good news. So many people started to buy, and on the next day, we see a new opening price that's way higher than the previous close price. That's what I'm talking about. The idea is generally to get in an earnings play around 1 week to 1 month before earnings. And I say that because, and I've chosen this chart for this purpose, many times if earnings is going to beat, that information slowly starts to trickle out a few days before earnings, and you'll see an upward trend into a good earnings report. And we want to capture that as well as the earnings. So generally, you want to get in around 7 days, at the very least 7 days before earnings, though you can still make money by getting in at this time, obviously. It's just that you have less ROI and you've got to act more quickly. Now, I'm talking about getting in before. For people who have looked at my courses and heard me talking about playing the gap after the gap, that's a completely different story. So that's the idea of whether the stock is going to continue moving upward after that gap, or if the reaction was overblown and the stock will start to fall. That's also pretty easily predictable. And if you want to know how to do that, you just need to go to Google, type the gap method, and that'll bring you to my website where I have a free guide. All you have to do is enter your email and you'll receive the free guide automatically. It shows you the basics of how I trade a gap after the gap. Today we're going to be talking about predicting the gap, and I'm going to make it as easy as possible. I don't want this video to run too long. I'm just going to give you the main predictors that I use. I use more than what I'm going to show you, but I'm going to show you the ones that are really important. Everything else that I do is just to raise the accuracy just a little bit, that 1 or 2% point per extra piece of information. I spend a lot of time doing this. I can't expect everybody else who has, full-time jobs or who's in the military or students, I can't expect you guys to spend the same amount of time I do on researching a single stock. So this will give you, I would say, 60 to 80% of the importance in my research. And if you just consistently use these indicators, you should do pretty well as an earnings trader. So let's start with the basics, which are you of course need to know the ticker, and you need to know the date of earnings. Remember, we want to get in 1 week to 1 month before earnings, so when you find the date of an earnings report, you should also mark down, or at least make some sort of mental note when you need to get in that position. So let's do an example here. Let's say our ticker is Apple, and I believe Apple is reporting on the 25th. So let's say you want to get in, enough time before earnings so that you can capture any pre-earnings drift. I would say look to get in, 10 to 20 days around. Maybe seasonality is important too, but maybe you get in, let's say, mark down, I want to get on the 10th. So just make a note somewhere that you don't want to get in too late. You might want to arrange this by date in your Excel file. I'm recommending you put all this info in an Excel file. All right, so ticker, date. Once you got the basics down, now you can start looking at the stuff that's going to help you predict an earnings move. First one is the earnings pattern. What you can do if you want to do it by yourself is you can go back and look at the earnings dates of that stock and see if the stock has a reliable pattern of moving up or moving down on earnings. Many stocks do have a pattern where it's something like 60% of the time the stock moves up, or you might find a pattern where if the EPS beats expectations, then you get a rally, and vice versa if it's not so. All you're doing is you're looking for something that's going to give you a baseline to use for all the rest of the information you collect. You want to start with a baseline. For Apple is really random. I've run a lot of back tests on Apple's earnings, and I really don't see any patterns in there. When I look for a pattern, there's a lot of things I look for. I'm going to show you a few things. One is EPS. If EPS predicts it, if EPS beats, you get a rally. So that's one such pattern. EPS beats implies a rally. That's not usually the case though. Usually guidance is more important than EPS. But sometimes you have a stock that really does track EPS, and if EPS goes up, stock goes up. If EPS goes down, stock goes down. And I'm talking about with the benchmark of expectations. And you can find that expectation, by the way, on NASDAQ. You just type NASDAQ Apple earnings, and it'll give you the earnings date. So if you're wondering where to get the earnings date, all right, so we got May. If you're wondering where to get the earnings date, you can just go to NASDAQ earnings, and it also gives you the EPS prediction. So this time it's predicted to be $2. Now if it's higher, that's called a beat. If it's lower, that's called a miss. And the general theory is that a beat means a rally and a miss means a sell-off, but that's not always the case. Anyway, we're going to go back and look at a couple more patterns. You might have a quarterly pattern. Now, what this is a pattern that holds for certain quarters. So you might have fiscal quarter 1 rallies maybe 80% of the time, and then fiscal quarter 2 sells off something like 60% of the time. So that means going into earnings, you want to know which fiscal quarter you're looking at, because that will predict which way you want to be. I found a pattern like this on IBM that was really reliable. It's still really reliable. IBM sells off on all fiscal quarters at a pretty decently high percentage, except for fiscal quarter 4 when it usually rallies. So if you can find a pattern like that, you can mark down the dates you want to play that stock. You might say, okay, I'm going to short IBM on every earnings, but then I'm going to take a long position on IBM on fiscal quarter 4. So finding those patterns will give you a baseline for the upcoming earnings report. For Apple, like I said, I could not find a pattern, so my baseline is going to start at 50%. So starting at 50%, now we get to look at the other indicators and kind of tack on probabilities, add or subtract a probability that it's going to go up or down. The next thing I like to look at is, well, I'm reading directly from my Excel chart, so some of these aren't really useful to you. For example, one thing I have in there is post earnings, which is how it reacts after earnings, but that's because I often play the gap. We're not talking about that today, so I'm going to skip that one, and I'm going to talk about stochastics. Stochastics are important before earnings because even if you're right, and this is why it's so far in the beginning of my analysis, even if you're right about predicting the earnings pattern, say Apple, you predict it's going to rally on earnings because it beats on EPS. Let's say that's your prediction, and let's say that that is actually true. The stock could still not rally hard, or it could actually fall backward because it's overbought, because so many people already know that Apple's going to posts a really huge EPS beat, it's somehow already priced into the stock, and the stochastics will tell you that before earnings. What you need to do for stochastics is just go to any stochastics chart. You probably don't have that software, so it's not a good example. I often use stock charts. So you go to stockcharts.com and you want to find the stochastics of Apple, AAPL. Here's your Apple. Now we want to look at the stochastics indicators. So we're going to choose stochastics. You can choose any of these. For earnings, I usually use fast stochastics, but the truth is I look at fast and full at the same time. They're not always the same, but they're usually the same. So I'm going to do those two. Now we've got the fast stochastics at the top and the full stochastics at the top. Luckily, well, not luckily, usually, as what usually happens, is they're both saying the same thing. They're both above the 80 line. You see the 80 line there? They're both above the 80 line. And the fast stochastics is tipping down right now. It's crossing below the 80 line. So the fast stochastics is actually giving the first sell signal. The full stochastics has not given the full sell signal yet. Now, I consider this to be the first but the riskiest sell signal for Apple. This is the time at which, if you're a very risk tolerant trader, you would want to take a short position on Apple. And the second earliest signal would be seeing the same thing in the full stochastics. So that's what you want to look for. You want to see if the stock is overbought, in this case above 80, or oversold if it's below 20. And once the fast line is the %K line here. It's the black one. Once the black one passes below 80, that's your sell signal. That's your earliest sell signal. When the red line passes below 80, that's a later sell signal. It's a lot safer, more reliable, but you also lose generally some of the gains you could have got if you had gone with the fast signal. So what I'm seeing here is that Apple is overbought, and I would not play Apple even if I thought it was going to beat, because it looks already priced in. It looks like there's nothing I can do about the information I have versus the information the public has. What we're trying to do is we're trying to get some info that the public doesn't really use when they trade, so that we have an advantage over them and know which position to take. All of this is just finding something that's undervalued or overvalued and taking the right position. That's all stock trading is. Now, what it's telling me is that Apple is overvalued, but it might be overvalued for a reason. So if we're going into earnings and we're predicting earnings is going to be strong and we see that it's overvalued, what that means is earnings is probably priced into the stock and it's not a stock worth playing earnings on. That said, we're going to move on using Apple still, just because it's an example, and look at the next indicators. Another important one is momentum. Now, it's not like the stochastics where it makes or breaks a trade, but if you see a stock moving in a certain direction reliably and you want to bet against it, that's generally more dangerous. We always want to go with the flow if possible. If you're going to be betting against momentum, you're making a contrarian play and you're hoping for a turnaround. And turnarounds are a lot more rare, but there are certain stocks, there are certain times when a turnaround is likely, and I'll talk about that in a bit. But you want to check the momentum. Now, researchers, when they talk about momentum, aren't always talking about the same thing because they use different time periods. Some use 3 months, some use half a year, some use 1 year. My recommendation is to use those three I just said all together and then take the average, and that'll give you a pretty good idea of the momentum of the stock at the moment. If you are betting against the momentum, be a lot more careful. Make sure that your thesis for the earnings report is going to be strong, stronger than average, because you generally don't want to bet against momentum. All right. The next thing I do is I look at the upcoming month. So right now it's April. So I look at April, May, and June, and I want to know the seasonality. So for Apple, we might find that most of the time April is up, or most of the time May is down. I just do this in code form, and it gives me Apple and how often it's positive. And I look at the past 5 years, though sometimes you might want to go out further. I think the past 5 years is pretty accurate, and that's another issue. We could talk about that another day. But the idea here is that we want to be more recent. We don't always want a huge data set. So what we're doing is we're looking at the percent positive, because that's going to be more reliable than just a Sharpe ratio. There are some stocks that will say 100% of the time it's been up. So over the past 5 years, you might find that one month was particularly strong, and that's the month you want to play in. So what we're looking at right now is Apple is up 60-something percent of the time here, and then 80 May, and then 40 June. So I would mark that down. So I would say something like 65 April, and then May is 80, and then June is 40. So what this tells me is, because Apple is reporting in May, and Mays are strong months, I would think that it's probably going to be an indicator that earnings is going to be good. And I might go find a pattern and find that, if Apple reports its fiscal 2 quarter later or earlier, it typically rises or falls. But an 80% mark, an 80% probability of being in the green at the end of May is probably at least somewhat related to the company posting its earnings in May, if it does it every May. So again, we start out with a baseline with that pattern, but then we add on the other metrics. So I might say, because the stock is oversold, I really want to play that, so I'm going to up the probability, because I think the earnings, if it comes out and if it's a beat, lots of people will start buying, especially when they see that the price is so low. So all that stuff is important to quantify and add to a final percentage that you're going to give it. So at the end, you'll say, I think Apple is going to beat with a 60% probability, and then you can actually bring it back to your own trading style. Am I risk averse? Am I risk seeking? You would have to be pretty risk seeking to take this, unless the upside is really high. And I'll talk about that in a second. So again, check the seasonality. You can go back and count the months. I just said that you don't need a huge data set. Just the last 5 years would be fine. And you only have to look at the month that Apple's reporting in and the 2 months besides that if you plan on holding longer. Next, I look at a trend that's very indicative of how a stock performs in the future. And that trend is looking at the ratio of EBITDA and EV. So what you have here is just pure earnings, essentially, and this is the value of the company. You take this ratio, and you'll find a pattern which will give you an idea of how the company is moving, and most importantly, can help you predict the future of the stock. Now, you could just go check that for the past few years, calculate it by hand. It's pretty easy. I do it by code, and I plot it, because sometimes, I think this is it, because sometimes what I'll find is that it works really well with the stock. There's a correlation. If this ratio moves upward and the stock moves upward, then I know that this is a pretty strong indicator to use. But if it doesn't, then I might give that less weight. Remember, ultimately we are subjectively giving all of these indicators probabilities and then adding them up, or not adding them up, and then calculating it so that we have a final probability. So here I would say, I can't tell much from this. The stock looks to be trending somewhat sideways. This is a different stock, by the way. And the EBITDA to EV varies wildly and has always been under 0. Because of that, I probably wouldn't give much weight to this factor. But for most cases, if it's going up or going down, I will factor that in to the prediction. And in this case, what I would see is it's trending downward, right? We see EBITDA EV is lower than before. And I guess this is the current calculation, but I don't care about that because that fluctuates. So what I'd see is just the past couple years, it's been falling. I'm going to assume the trend continues, and I'm going to dock the prediction a few percentage points for that reason. So that's what you want to look at. Specifically, you want to look at the pattern. Then, let's see here. All right, then you want to look at PE. And I have a lot of indicators here. I'm just going to write, I'm going to write PE. I'm going to write PE versus industry, because this is the most important part of analyzing a PE before earnings. So PE is the price to earnings ratio, and you can find what I'm going to tell you to look for is the price to earnings of the company, of the stock, divided by the average price to earnings of the industry which that stock is in. The easiest way to do this is to go to Morningstar. I just go to Google, I type Morningstar, the stock ticker, AAPL, and then industry valuation, and it usually brings me right to it. So I'm going to click on the first link here, and here we are. So we have the price to earnings of Apple at 17, and the industry average is 18. They're about the same. I wouldn't really care about this indicator in this case. But if you see that the PE is far below the industry average, that's a very bullish sign. Not bullish because of the probability of a beat. This really doesn't imply anything about whether the stock is going to rally or fall, but it does imply a lot about the payoff if you're right. If the price to earnings is very low and the versus the industry average, and the stock rallies, it's going to rally hard. Now, the flip side, if it's really high versus the industry average and the earnings is not that great, it could sell off hard. So I'm actually looking for stocks that have big differences between their own PE and the industry average, because that gives me the plays that are going to move the most. So that's what you're looking for there. I would write down something, just calculate the ratio. So I'd say 17 to 18. That's almost 1. So I think the upside versus the downside, the risk profile is roughly fair. I'm not going to expect it to move up more on a rally than down on a sell-off. All right, and the final thing that I'm going to give to you guys, because we're already at 10, but ticker and date don't really count. I'm going to give you the last one, just an extra one here. Insiders buying and insiders selling, and that ratio as well. So what many people think about insider trading, that is people in the company buying or selling stocks, is that they're indicative of how the stock is going to move. Now that's true, but only in the buying case. It's true in the buying case. Studies on insider buying have shown that when insiders buy, the stock outperforms. But they didn't find anything. There's been no hard evidence that insider selling is indicative of future stock underperformance. Selling can reflect, and often does reflect, a person hitting a price point he hopes to hit and then taking profit on that, or it could just be someone who needs money and they want to liquidate what shares they have in their company. So that's not really important, but I think the ratio is, because it tells you how many people are active in the market of their own stock and how many people are buying versus, well, that's literally what I'm talking about. But what I mean is, if you look at the activity and the activity is mostly people putting money into the company, it's probably pretty bullish. It's a bullish sign. And I like to see that before earnings. If I see a lot of selling and no buying, I will take that as a bearish signal, even though it's not statistically a bearish signal. Because honestly, if you think logically, you're not going to sell stock before an earnings report. If you're inside the company and you know so many details about the company, you're not going to sell stock before an earnings report if the company has been doing really well. So I look at the past 3 months of insider trading before an earnings report, and I take that into account. Now, in the end, I will take all of these indicators and subjectively from that baseline, so let's say we start with the 50% baseline on Apple because we didn't find a pattern, or let's say we do find a pattern, we start with the 60%, meaning 60% of the time it'll rally, 40% of the time it will fall. We start with that. Then we see the stochastics are oversold, so that makes me more confident. I'll put it up to 65. I might just wait by 5%. Then I see it really perform strong in May, and I'm now thinking I should probably consider 80% as the bench line. But that's a little far because I prefer to look at the earnings pattern because it covers just a few days, whereas the month covers a whole month. So I don't weight this too heavily, but the fact that it's been up so often in May and so strongly, we don't have that anymore, I would maybe add 10 to 15%. I might move it up to 80%. Then if we find the pattern here is falling, you might dock some points. And what you're going to do is you're going to end up with a probability. Obviously, I'm just using an example. You're going to end up with a probability. The more precise, the better. And you'll end up with something like, 90. I found probabilities of 90 before. I've played 90 before. But most of the time, it's going to be something like 64%, 74%, or 69%. It's going to be something realistic, near the middle, near 50%, but far enough away 50% to where if you played this over and over, the law of averages would be on your side, and in the end you would be making money. Assuming that, again, you're playing on stocks that are either fair or in your favor when we talk about that risk profile, when we talk about the potential payoff versus the potential loss. Now I play options instead of stock because it's safer. I can manage my risk that way. You might not want to. That's really up to you. If you want more information on playing earnings, what you could do is you can come to my earnings newsletter. It is a paid subscription, but we have live chat inside and it's pretty active. What I do is I will post some of the more interesting tickers to play in the upcoming days and weeks, and I also post the occasional in-depth report that selects a stock to look at in depth before earnings to give you pretty much all the information you need. Basically what I said plus a bunch of fundamental data and other stuff, and I'll give you all my charts of the data in that newsletter. So if you're interested in that, please sign up. You can just sign up for a month and see how it works out, and join us.